Reserve Bank surprised markets last week by projecting official cash rate increases from mid-next year. Now, government bond yields since then have gone up, swap rates are up, New Zealand dollar has risen. Is this how the Reserve Bank expected the market to react?
It's an interesting reaction, isn't it? If you look at the sort of the underlying message that we were portraying, it was sort of well in line with the vast majority of expectations around our policy message that we're, the recovery is unfolding broadly as we outlined in February, and we're having increasing confidence that this would be sort of sustained over the next 2 to 3 years. I guess the new information was we went back to publishing this OCR track that we'd gone away from the better part of the last 12 months. So that, I guess, was news, and rightly so. Markets have tried to digest what that means. We've tried to say, again, think back to the pre-COVID days when we published an OCR track. It was always a highly conditional path. There are still a lot of uncertainties that we see in the outlook, even though we're a bit more confident about the central outlook. But it still remains conditional. But if all those assumptions underpinning our outlook comes to pass, then I'd say, the economy does feel like it's normalising, and it probably would be time to be lifting interest rates in the second half of next year.
Do you want to see retail banks raise mortgage and term deposit rates, start raising those this year perhaps, ahead of an OCR increase?
Oh, that's not for us to say. All we can do is lay out what we think is the best path for the OCR and monetary conditions more broadly, and then we'll watch and observe how the economy responds to that. So we're still saying we want to keep monetary conditions stimulatory at current levels, so that's not a sign to go raising rates. It's basically keeping interest rate settings broadly where they are for the better part of at least 12 months as the economy recovery unfolds.
Okay, I just wonder what the purpose was of putting those forecasts in there, whether you wanted the market to start doing some of the work for you, moving out of that sort of emergency phase.
Yeah, I mean, it's interesting. If you go back sort of 12 to 18 months when all this started, we had an unconstrained OCR path, right? So we recognised that we couldn't bring the OCR down any further, but we needed to show people the total sum of all our policy actions to provide more stimulus, and that was captured in this unconstrained OCR path. A lot of the feedback we were getting at the time from market practitioners was, how do we interpret what this is? And they were sort of nudging us to say, well, at some point it would be good to go back to publishing an OCR path, which they well understood. We felt now was about the time to sort of be able to go back to the old way of producing economic projections. As I talked about, we've got a bit more confidence in the underlying economic picture, the central projection and the assumptions that sort of are, that they rely on to be able to go back to communicate how we see monetary policy evolving through this OCR path.
Sure. Yuong, a lot of people will be thinking, look, the Reserve Bank really can't raise interest rates too much at least, or banks can't do it too much because households are so indebted and a lot of people leveraged up last year. Does this thought keep you up at night? Are you worried about interest rates rising and the impact that might have on households?
Not really. I mean, we totally understand that low interest rates meant that people borrowed and some, have higher amounts of debt, and conscious that, well, when interest rates rise, there will be the natural adjustment profile. That's actually how monetary policy works, right? So we don't sit here blindly raising interest rates. We actually, as we raise interest rates, observe how the economies are responding to that. So from where we sit, where we're saying interest rates on hold for the better part of the foreseeable future, we want to maintain stimulatory monetary policy. But if the economy recovers as we foreshadow in the central projections, then you may be looking at a situation where things are getting back to normal, and then normal will look like a position where interest rates are higher from here.
Okay, so our high household debt, and particularly when it comes to mortgages, that is not a potential constraint in the Reserve Bank's thinking when it comes to potentially needing to raise interest rates.
It's not a constraint, it's actually factored into how far you would actually raise interest rates.
So right? You're going to get bang for your buck.
Exactly, yeah. And it's not so long ago people were saying, well, monetary policy was ineffective, right? So I think it's kind of strange to hear now it's being flipped on its head that, well, you better not raise interest rates because you might have too much impact. So we just say, look, we take into account the transmission of monetary policy through various channels and then figure out what is the appropriate stance of policy to achieve our inflation and employment remit objectives.
Okay, some economists are forecasting OCR hikes from as early as May next year. Could you foresee a situation where the Reserve Bank increases the OCR, but the large-scale asset purchase program and the funding for lending program is still running? Because those programs are due to run to June. So would it be sort of weird or counterproductive if the OCR went up, but those programs aimed at keeping monetary policy loose are still ticking along?
It's an interesting question, and we get variations of this from a lot of the market participants trying to understand what is this new world we're going into. And the best that I can give is the LSAP program and the funding for lending program, they remain operational. They're doing their job in the background. What we're now stepping into is a world where we're more comfortable communicating and signalling and actually doing monetary policy through an OCR tool. How that works out in terms of LSAP and OCR, that's to be determined, but we are saying, look, we want to keep conditions stimulatory here for a while, and when we do want to change any of those calibrations, we'll tell you through the normal monetary policy channels.
Is the Reserve Bank wedded to having those programs run through until June next year?
Yeah, the Monetary Policy Committee reaffirmed that we want to continue with the LSAP program. We'll get to reaffirm that every 6 weeks, and until that position changes, it remains in place.
Young people might look to other countries that have done quantitative easing, which is the same as our large-scale asset purchase program. Other countries did that after the 2008 global financial crisis, and that has continued. Will we in New Zealand see a continuation of some sort of quantitative easing past June next year?
Well, time will tell. I mean, it is an interesting question. So from where we stand, our program runs till June next year. So our balance sheet will look what it looks like in June next year, and from then on it will sort of maintain that size. Eventually, when we normalise, touch wood, we get there sooner rather than later, we may look to scale back our balance sheet. So that would be effectively reducing the large-scale asset purchase program, because we're saying we no longer need monetary conditions as stimulatory as they are. We can start normalising, and that would actually involve reducing the size of that LSAP program. How
do you normalise it? Can you just explain the mechanics of that?
Sure. At the moment, as we're buying government bonds, our balance sheet is growing in size. So its peak size should be reached in June. That's when the program ends. Okay, and at that point in time, the decision we'll have is basically to maintain the balance sheet at that particular level. Okay, you'll have particular decision points about when bonds mature that we purchased previously. We will reinvest them to essentially maintain the balance sheet stock at that size. If at some point in time we go, actually, we no longer need conditions as stimulatory, we can choose to do that by reducing the size of our balance sheet. So as bonds mature, we would just let them fall off our balance sheet, and our balance sheet would shrink back to potentially where it was pre-COVID.
Okay, as opposed to buying more bonds.
More bonds, yeah.
To keep that balance
sheet. To keep
reinvesting,
to keep the balance sheet high.
And so a bond is an asset, and so that's...
So as we sell our bonds or let them run off their balance sheet, the supply and demand balance would change, okay, and naturally that would put upward pressure on interest rates, much like raising the OCR would do. So during the asset purchase buying stage, we were putting downward pressure on wholesale market interest rates. The reverse would happen when we would actually reduce our balance sheet.
Okay, look, in terms of economic growth and inflation, where do you think the inflation and the economic growth is going to come from, looking to the medium term? If we have reduced immigration, reduced house price growth, reduced tourism, and I'm not sure what's going to happen with dairy that's under pressure with our move towards having a more sort of climate-friendly economy, where's the growth coming from?
Well, depending on which industries you talk to, they'll tell you they're doing better, or activity levels are back to levels they were experiencing pre-COVID. So there are some industries that are still struggling, the ones who are exposed to international tourism in particular, but a lot of the domestic-facing industries are doing incredibly well. And the fact that we're hearing signs of emerging skill shortage or labour shortages in some sectors, that demand is strong, but supplies are hard to come by. They are sort of all telltale indicators that a recovery is unfolding. It will obviously, in the big scheme of things, at an aggregate level, what we're seeing is an economy that has started with low inflation, below our midpoint of our target, and one where labour utilisation is probably lower than otherwise. So we do see slack on both the labour side and inflation that's below target. As the recovery unfolds, those resources should get pulled into utilisation, and inflation pressures should gradually re-emerge. How that looks like for certain industries, that'll be the challenge for those participants.
I mean, is it at all concerning that we could have inflation coming on the back of wage growth, and that wage growth coming on the back of skill shortages, not on actual productivity increases and things like that? So we have a situation where we have inflation, but we don't necessarily have lots of economic growth underpinning that inflation. That inflation is coming from wage growth, which is coming from skill shortages.
I think what you're describing there is just the natural way business cycles work. As demand picks up, firms want more labour. They find labour hard to come by. The relative balance between demand and supply changes, so wages get bid up. That, to me, is just the natural process of an economic recovery. What we're concerned about from a monetary policy perspective is that you don't get inflation expectations becoming unanchored, so people feel like, well, I can put prices up because everyone else is putting prices up. Which is, price changes happen all the time in the economy. What we're worried about is sustained inflation rather than one-off inflation. And we see a situation where inflation at the moment is below 2% and will rise gradually above 2% in the short term because of one-off price increases. So oil prices and other commodity prices have been baked into the system. We should see headline inflation probably rise to about a peak of 2.6%. But once those numbers drop out, we should see a picture of sort of moderate inflation, but building as the economy recovers.
How stimulatory did the Reserve Bank consider the budget to be?
I think we basically reinforced our view that monetary policy, fiscal policy will remain a key support partner to the recovery. It's just given us that little bit extra confidence that the fiscal stance will remain stimulatory, and hence the recovery that we were foreshadowing in our projections, is more likely to take hold.
How stimulatory though, because the Treasury revised down its forecast bond issuance, but it didn't revise it down as much as the market was expecting.
In an absolute sense, fiscal policy is undoubtedly one of the big stimulatory levers that's supporting the recovery alongside monetary policy. The outlook we're seeing today, unfolding, wouldn't have happened without the previous fiscal interventions, principally the wage subsidy, but also with the pipeline of expenditure and investment that's planned in the budget.
Okay. And look, finally, the Reserve Bank has done some work on the distributional impacts of loose monetary policy. So just for people listening, this is largely around when the Reserve Bank lowers interest rates, then how does that stimulus filter through the economy, and who does that benefit and who does it perhaps not benefit? The analysis that's been done so far largely draws on inconclusive or different international evidence. It doesn't really hone in on the evidence in New Zealand.
Mm-hmm.
Now, I understand it's kind of relatively early days, but should we not have a more granular analysis done at this point around the distributional impacts of such a seismic program?
Absolutely, and that's what we're committed to doing. Challenges around New Zealand is access to data, but we are looking at all those issues to get a better handle on how is the monetary policy transmission channels, have they worked, and how are they continuing to work, particularly given the different range of tools we've had to use during the COVID crisis.
A generation of people has potentially been locked out of the housing market. I know price increases will projected to flatline. We'll see what happens, but they'll be thinking, is it good enough that the Reserve Bank is still working on doing some research?
Mm-hmm.
Do we not need to see something granular, because then that helps the government create policy as well if it knows the impacts of what the Reserve Bank's doing?
Yeah, but it's also important to realise, employment, the labour market outcomes we've observed today have been much better, or not as worse as we had been feared, right? So part of the way monetary policy works is about sustaining economic activity. Yes, there will be unders and overs, and that's what we're trying to learn through our distributional work. But fundamentally, our mandate is about supporting full employment and getting inflation back to the midpoint, because that's the best contribution we can make over the long term to the economic well-being of New Zealanders. Okay,
when will we see more granular distributional impacts analysis?
I couldn't give you a timeline, but it is something we're actively working on. We have a remit review time for 2024. So we know that a big part of the remit review will be going to look at our recent experience with monetary policy, particularly with our dual mandate, and distributional outcomes will be a key part of our analysis.